So in the valuation, we first analyze the historical financial statement. That's our starting point. We try to identify the primary drivers of the cash flow, right? Using the historical data. And then you project next 3 to 5 years of financial statements on a pro forma basis. What is basis? This is called the planning period or forecast horizon. And then beyond that, we estimate the present value of cash flows beyond the forecast period. This is called the terminal value. So we have to construct the history and find share statement. And by looking at the history and the analysis of the history of the company's performance, we try to determine the key factors to the company's performance. These are called the value drivers. And then you project the financials of the target company on a standalone value. Without the merger, if the target operated by itself, or to be the future cash flows, and then you will see if you marge for the synergy value from the margin, which is separately calculate, and then you add number 2 and number 3. The standalone goal of the target, and the synergy to get the target's value to the bidder, okay? So this is what I would suggest, for, when you are doing the case study, and trying to value the target. That is, you value the target separately by itself, which is called the standalone value. Then you value the synergy from the margin as a separate item. And then that gets 2, if we add those 2, that gives to them, target's value to the bidder. So step 1, as you see, you analyze the recent financial statement to figure out the value driver, which are the variables that really drive the operating cash flow. And therefore the value of the company. So they'll be correlated without putting cash flow, meaning that the variables, when the change cash flow changes. And this include like growth in revenue, profit margin, it could be gross profit margin, net profit margin, and things like that. Yeah, now, to do this analysis, we have to normalize the historical data for any kind of non-recurring items or asset sales. So there is a one-off losses that will not happen again, then you sort of add it back, or you make sure that it does not include it in your feature analysis, because this is just one-off item, and even in the past analysis, who take out the one-off losses, or even gains from asset sale. If it's one-off things, you take it out in the historical data, so that when you focus the future based on the historical data, you are not forecasting this one-off items, because they are not very likely to happen in the future.